Good evening, traders and investors. Will back here with another one, coming to you with a Friday and weekly market recap. Hopefully you guys had a great day in the markets on Friday, and since I'm filming this one on a Saturday evening, I hope you guys are off to a very nice start to the weekend as well. So in terms of Friday's action, we had a pullback on the SPY and the QQQ, but we did have some pretty decent rotation in some sectors of the market if you knew where to look. Overall, it was not a bad day in the markets. In terms of data that we received on Friday, well, we got some information on retail sales, and retail sales actually not that bad. It came in at about 0.5% month over month, which was the actual consensus, so no real change there at all. And we did have some information in terms of the Michigan Consumer Expectations Index, a closely watched survey in terms of the soft data, and apparently consumers are a bit more bullish on the economy at this stage in the year than they were prior in the months of April and May, of course, coming in at 57.2 versus these 56.5. Those are really the two biggest pieces of news that came in during regular market hours, but there was a lot of anticipation in terms of what was going to happen towards the close. And of course, that had to do with the famous Trump and Putin meeting that happened on the Friday session, in which there were supposed to be discussions of negotiations as to a ceasefire or peace talks between Ukraine and Russia. Unfortunately, we didn't really get many new developments here, the summit ending without a concrete deal, but we will obviously keep close attention to this coming into next week, of course, as in the next coming days, President Zelensky will also be involved in the negotiations, so hopefully we can start to see some form of progress in this whole landscape. So in terms of today's video, what we're going to be doing, guys, is a couple things. Number one, we're going to be going over two company earnings that had earnings last week. Those are going to be Applied Materials and New Holdings, both of which reporting after the close on Thursday. Applied Materials taking a very big dip and led to a lot of the semiconductor weakness that we saw during the Friday session. So we'll be deep diving those earnings, see exactly what happened, why the entire semiconductor industry dropped off of that. And then obviously after New Holdings, probably one of my favorite fintech plays in the market, but nobody really talks about it too much. After we are done with those earnings, we will take a look at our major technical analysis rundown in terms of our major market indexes, check on the rotation, which sectors are leading, which sectors are lagging. Thereafter, we're going to go through our big tech list and do the same thing, which names are performing well, which names are lagging, and can we derive some either trade opportunities or some long-term portfolio position opportunities as well. At the very end of the video, we'll be taking a look at my portfolio for some trades made throughout the week and which positions, of course, I'm keeping into next week. As you guys know me, I always like to keep some positions into the next week, but I'm a big fan of taking a lot of profits when profits can be taken. So we'll take a look at all of those trades at the end of the video. Without further ado, let's jump right into the action, shall we? So SPY down about 0.23, the Qs down about 0.44. Overall, though, guys, the heat map wasn't all the best, but we did have some pockets of positive rotation. Take a look. The big tech names, for the most part, were mixed. Microsoft, Apple, Tesla, Amazon roughly flat or down. Google and Meta, though, continuing to outperform to the upside. Although semiconductors were down as a byproduct of the AMAT, Applied Materials earnings, we did have some nice gains in software. And we've been commenting, guys, that over the course of the past 1 month, software was getting completely destroyed. But now we've had some really nice rallies off the bottom. So in today's video, we'll spend a little bit of time discussing this rotation possibly into software, which might free up some short-term opportunities for some trades. Financials sadly unwinding a lot of the gains from last week, and healthcare continuing on their push to the upside. It's been a very good week for healthcare. Of course, the biggest catalyst for the week here is within the context of the healthcare insurance providers, namely UNH, of course, after Warren Buffett unveiling his new stake in the company. Warren Buffett loves his insurance companies, and this was a pretty cheap one at the time that he did buy it. The bottom half of the market a little bit struggling as yields are still a toss-up as we await some details into the September meeting from the Federal Reserve. Is there going to be a rate cut? Is there not? How much is it going to be? And what is their expectations moving into the end of the year and for 2026 as well? That's why some of the bottom half of the market here, some of the more interest rate sensitive sectors have been very wild in terms of their price action in the most recent few weeks. Taking a look at your one-day relative performance, you can see that the markets were really upheld by, that's not the correct one, let me just refresh, there you go, healthcare, communication services, and real estate to the upside, everything else pretty much to the downside. But on a 1 week relative performance after the SPY and QQQs hit many new all-time highs throughout the weeks, it wasn't that bad. Healthcare, cyclicals, communication services, financials, materials, and energy, your market leaders. And to the downside, sadly, technology pulling back a little bit, utilities, and consumer defensives. So all in all, not that bad. We still stand in a position in the market where investors seem to be more on the greedy side than on the fearful side. And we are currently still in a very topsy-turvy period of market seasonality. It can really go either way. This has been one of the better August months so far, now that we're midway through the month, but you can see here that seasonality tends to be a little bit choppy. Although the sample size is only of the last 20 years on this chart, it can really still go either way. But we know that this is not the easiest environment right now for directional trades with a 2, 3, 4, 5, 6 week time horizon, because sometimes a lot of the moves can be quick and get unwound just as fast as well. So I'm a big fan of long-term positions in this market. So themes that will play out through Q4 and even into 2026. I'm a big fan of those longer duration trades, but swing trades need to be quick and fast, and really you have to do them with defined levels of take profits and stop losses, because holding anything for a 2, 3, 4 week period only can be a little bit choppy with this seasonality. So before we move into more technical analysis, guys, let us dive directly into our earnings presentations. And we're going to start it off, of course, with Applied Materials, the one name that brought the entire sector down on the Friday session. You will see here that they closed the day minus 14%, although they had pretty decent earnings. EPS beat by 5% and revenue beat by 1%, but it was all in the guidance. That was the reason why they came down. Some of the easier numbers right here, you'll see that revenue year-over-year basis was up 8%, very strong. EPS was up 17% year-over-year, net income up 4% year-over-year. And this company usually has really good net income margins, talking anywhere between mid-20s to high 20s net margins. So very profitable company overall, and gross margins rising as well. I'll remind you guys before we get into the earnings, because I know there is a ton of semiconductor plays out there, and I know some of you guys know this stuff, but a lot of you guys kind of struggle to piece together the entire landscape, the entire chain of semiconductors. What do some of these companies do? Because I know when you look at some of their earnings sometimes, especially some of the equipment corporations such as AMAT, well, it can be a bit cumbersome to understand what the business model actually is and what part do they play in the semiconductor landscape, because sometimes you kind of almost need an engineering degree to understand what these companies do or what their products do specifically. So take a screenshot of this. This is probably going to help you guys out a lot in the future. This is the semiconductor value chain, and it all starts right about here. Let me actually get my annotations on, and I'll show you guys. It all starts right here with the design of semiconductor chips. So the chips that we're looking for, right? Then we also have companies that are called fabless design companies. These are companies that do not manufacture their own semiconductors. They derive designs for what they want, inspired by designs that are given to them already. So these guys and these guys go back and forth on the design platform, and thereafter the designs for the chips are sent to the foundries. So these are the guys that make the actual chips. You got UMC, you got Global Foundries, you got TSMC. Samsung and Intel are not there, but can be included there as well. But these foundries obviously need equipment to manufacture all those chips. That is where all of these companies come into play. Talking about KLA, talking about ASML, Applied Materials, Lam Research. All of them have different machinery, right? Whether it's the actual manufacturing machinery, refinement machinery, testing equipment for semiconductors, either before they made or after they're made in terms of quality control. So many different parts of the puzzle right here in terms of the equipment side. So Applied Materials is part of the equipment side of the equation, of course. So just understand that that is the sector that we're looking at right now. And of course, this is the sector that got hit the most hard on the Friday session. As you can see right here, most of all your equipment manufacturers, like, I guess my head is in the way, so let me move myself over. All the equipment manufacturers, right? LRCX down 7, AMAT down 14 off their earnings, KLAC also down around 8.5%. So these are the companies that got hit the hardest. Just wanted you guys to understand that before we dive into the numbers to understand exactly what we're looking at here. Now, Applied Materials shares sink 10% on light forecast amid macroeconomic uncertainties. Let's move into the article. What was their guidance? Why was it so bad? The semiconductor equipment company provided an outlook for the current quarter that came in light. Applied Materials said it expects $2.11 in EPS. The consensus, $2.39. They missed EPS estimates for the next quarter by 10%. That is a very large amount. In terms of the revenue outlook, $6.7 billion in revenue for Q3. The estimate, 7.34. So a 10% miss on EPS and also a 10% miss on revenue guidance. Those are big numbers. So you could expect the company to be down at least 10% because of that. And that's exactly how much they were down. What the CEO had to say was that macroeconomic and the policy environment is creating increased uncertainty and lower visibility. He said the company's China business is particularly affected by the uncertainty. And here's the problem, guys, is that a lot of these foundries, let me just bring up my screenshot again, are located specifically in Asia. A lot of them. Now, some of them are US based, but a lot of them, whether they're here or integrated device manufacturers to which AMAT supplies as well. They go both ways, to the foundries and to the integrated device manufacturers down here. A lot of them are located within Asia. So that is why it's such a big problem for this company right now. Applied Materials produces tools for chip foundries to physically make chips, much of which currently happens in Asia. As we were saying, Applied Materials said that it has a large backlog of pending export license applications with the US government, but that it's assuming none of them will be issued in the next quarter. So they essentially sandbagged their entire guidance as if they were not going to do any further export to the Chinese market. That's why the guidance was so bad. Here's what the CEO had to say further. We are expecting a decline in revenue in the fourth quarter, driven by both digestion of capacity in China and non-linear demand from leading-edge customers, given market concentration and fab timing. He added that it expected lower China business to continue for several more quarters. So meaning this company's pipeline for revenue and backlog is going to be bumpy, not just for this upcoming quarter, but maybe for the next 2-3. Now, they did report net income of $1.78 billion, which was right around 24-25% net income, which is standard to the company's history. The company's most important division, Semiconductor Systems, reported $5.43 billion in sales, topping estimates and representing a 10% rise from last year. We'll get into the slides soon, but I just want to show you guys exactly how their business is broken down. So here's Semiconductor Systems, where they generate the most of their sales. This is the machinery that they produce, okay? Their services is essentially when this machinery is shipped and now utilized by the foundries or the integrated manufacturers, they provide services, meaning actual servicing for those machines because they need to be upkept. And then they have a third line of business, which is known as display. So this company is a pretty big player, guys, in terms of the equipment used to manufacture LCD panels, whether that's for TVs or computer screens and things of that nature. So those are the three lines of business. So when they talk about Semiconductor Systems having a very decent quarter, that's the main line of business. So you do want to see that. That was 10% up from last year. Applied Materials was praised by President Trump earlier this month after it was included in an Apple program to make more chips in the US. Apple said it would partner with the chip maker to produce more manufacturing equipment in Austin, Texas. So kind of getting away from the tariffs, at least for their Apple production. Now, in terms of looking at the company's earnings at a quick glance, you will note here that this is the reason that they were praised. They are the largest U.S. manufacturer of semiconductor equipment, and they are investing a lot of money, $200 million in Arizona, and building upon $400 million previously invested, so very strong. They're one of the biggest and best players in North America for those purposes. Now, they did have the sixth consecutive year of growth, in fiscal year 2025, which is very good. They do claim the long-term growth thesis remains unchanged, driven by a global race for AI leadership. However, you got to take this with a grain of salt because although they will be growing, they're growing at a very slow pace. And this is one of my problems with this company. It's a very strong company and it's a very critical player in the whole semiconductor process. However, their growth is very slow for a company in their pretty much division. You can find companies in this division, semiconductor equipment, that are growing a lot faster than Applied Materials. Moving on further, guys, if you take a look at some of the headlines, or rather some of the highlights here, in terms of their growth, right? So Semiconductor Systems, as we said, 10% revenue year over year. But look at the operating margins, very strong operating margins, very stable as well. Even in their services division, you can see upticks and slight downticks here, but very strong operating margins. And they've been making very good progress on improving the operating margins over the course of the last 5 quarters. for the display portion of their business. Even though we don't have the biggest amount of revenue there, at least they are trying their best to improve the operating margins in that smallish segment of the business. Now, one thing that this company does very well, guys, is it keeps its shareholders front and center in their minds, right? So you'll see here that cash and cash equivalents is very solid in terms of the amount of total cash and investments that they have, 11.1 billion, not too much debt. So their balance sheet is still very strong. They do generate a decent amount of free cash flow per quarter and per year. Right now, $2 billion in free cash flow. In the past 2 quarters, they spent a lot of money on new facilities, etc., as a lot of other corporations did. So their free cash flow was a bit lower. But on a per quarter basis for the last 2 years, the average has been about between $1.7 and $2.2 billion per quarter in free cash flow, which gives them a fairly decent free cash flow yield here, 4.4%. It's not the best in the industry, but it is still pretty solid. Now, also what they do with that free cash flow is 80 to 100% of the free cash flow is distributed back to shareholders over time. You can see they pay a decent amount of dividends, even though the dividend yield is not the highest. It's about 1%. They do pay dividends to shareholders. And additionally, they do a lot of share buybacks, $1 billion worth of share buybacks in the quarter. So their long-term shares outstanding count looks a little bit like this over the past 15 years. Very strong company buybacks right there. So that is also a bonus to shareholders. It helps bolster EPS and also helps just bring up total returns for shareholders over time. So overall, guys, I mean, we could spend a lot of time on these slides, but there's not too much else to really glance over. We went through the growth metrics, we went through the operating margins, the net margins, their free cash flow, and everything of that nature. And now we know that the next few quarters for them will be a little bit choppy. So at the end of the day, guys, knowing all of that, is this company a buy now that it's down 14%? Or should we possibly be exploring other equipment manufacturers such as LRCX, such as KLA, or even such as ASML? So we're going to compare this one with, which in my opinion is the best company in semiconductor manufacturing equipment, which is ASML. So let's do a brief little comparison right here. This is the one that I own in my long-term portfolio, ASML, right? Well, let's derive a possible thesis here for AMAT. So you can see here that the revenue growth per year for the next few years is only about 6.5% per year. It's really not that high. EPS growth is also only 7.5% per year. And this company, as you've seen, is not immune to the cyclical nature of the semiconductor business. So you really want it to have high growth rates. That way, when it comes out of the lull period of a seasonal pattern or cyclical pattern, you want it to have very strong growth. But unfortunately, we're not really seeing that with Applied Materials. They do a good job of keeping their EPS high with a lot of share buybacks, but look at the revenue growth. Revenue growth over the last four and a half years is just not that strong, guys. They've grown revenue only 10% in the last 4 years. That's just not high enough for me, unfortunately. Now, at 160, where the price currently stands, you're looking at a forward price to earnings of 17. You might think that this is cheap. Well, keep in mind, it's cheap for a reason, because they're not really growing that fast. Now, they have a PEG ratio of 1.97, so you can't get illusioned by this low PE multiple. Their growth rate is not that high, which means they still have a 2 PEG. That is very high, especially when looking to invest in this type of company. Price to sales at 4.55 is low, but keep in mind, they don't get an 8 to 10 price to sales because they're not growing that fast. And free cash flow yield, as we already stated, is a 4.4%. So the numbers are not too bad here. It's a very solid company, a lot of shareholder returns to be had right here. Okay, it's okay in terms of dividends. It has some great net margins, but the company just doesn't grow enough. And when we do a comparison here, apples to apples, if I look at the PEG ratio, the reason why I like the PEG ratio is because if you only look at price to earnings, guys, you're not going to understand anything, right? The PE ratio without any context is almost useless. You have to know how fast is the company growing and then put it on a common denominator. This is why we use the PEG ratio with an average growth rate over the next 3-4 years. Because if I only took the growth rate for next year, let's just say next year it's growing at 20% and then after 15 and then after 12. Well, you're going to be doing the PEG ratio with their best year next year. It doesn't give you a medium term or longer term good analysis for the company. So at a PEG ratio of 2, well, let's take a look at ASML, which in my opinion has the strongest moat, the strongest competitive advantage of any of the semiconductor equipment manufacturers in the entire market right now. So as we can see, ASML is only trading right now for a 1.6 PEG. Only a 1.6 PEG, right? Which is still very good. And they are growing revenue and EPS twice as fast as a company like AMAT. So I'm paying essentially more expensive here on AMAT for less amount of growth. ASML, I'm paying less in terms of a forward peg ratio, and I'm getting better growth. So that is why if I had to choose one semiconductor equipment manufacturer right now that is discounted from its highs, that has a very strong moat and a very wide competitive advantage, I would probably go with ASML. Shout out to AMAT though, not a bad company. I just think there are better plays in the market, and that's why we do this comparative analysis, right? To find in a certain niche of the market who are the best players at their current share prices right now. So AMAT, maybe you might find me playing it on the wheel strategy down here in the lower 140s if we can maybe get it into further daily oversold conditions. Some short puts down here into the very wide area of support. Wouldn't be that bad for a trade, but it is not one that I'm putting into my long-term portfolio. That being said, so hopefully you guys enjoyed AMAT earnings. That's all I had for you. Company number 2 that we're going to be exploring is a very fun growth company that not too many people talk about. This one in the fintech space, and that is going to be New Holdings. So New Holdings coming out with their earnings on Thursday. That a very nice 9 to 10% pop on the Friday session. Let's take a look at some of their numbers right here. They beat on EPS by 5%, but the highlight is they beat on revenue by over 16%. That was a fantastic beat. So if we take a look at some of the easy numbers for New Holdings, you'll see these right here. In terms of revenue, you're looking at 28.8% year-over-year growth. That is a lot. Deposits up 45.2% year-over-year. Fantastic. And the customer count up 17.4% year-over-year. Very, very strong numbers overall for this company. And as you can see, they beat pretty much all of the estimates that analysts had for the company. Now, in terms of what New Holdings had to say, in Q2 2025, we achieved another quarter of robust growth, expanding our customer base to nearly 123 million customers with over 4.1 million net additions in the quarter, and maintaining an activity rate of above 83%. Just means that essentially when customers come into their ecosystem, they are very active. They have a good customer retention rate as well, and they're improving profitability across many different segments of their customer base. If you take a look at right here, this is the revenue scale by New Holdings. So as you can see, since it's a fintech player and an online bank, a lot of their revenues is generated by income and fees, income on interest essentially. So if you look at interest income, the blue category right here for credit cards, look at how well they are pushing this continuously. You can see the arrows. You can see they had a bit of a slowdown period into 2023, into 2024, bit of a slowdown. They are re-accelerating growth to the upside, which is fantastic right now. The gray zone is interest income on lending. You can see they've really been expanding that interest income on lending right here. These are the gray bars on the chart. Interest income on other assets, which is the dark gray zone right here, also expanding. And also the teal ones down below here. So the bottom one, fee and commission income, that is steady up and to the right. It's not growing as fast as other segments, but it is a very nice position for them. And then we have interest income and gains on financial instruments, which is the light teal location right here. Essentially, from this whole picture, you just need to understand the company is firing on all cylinders, and most of all divisions of this company are generating more and more revenue on a yearly basis as they acquire new customers. Now, take a look as well at another slide that I figured was very noteworthy for you guys. This is their customer profitability. Here's your average revenue per active customer, the purple line. As you can see, as time moves on, they are able to monetize customers better. And what is the cost to serve these customers? Well, as you can see, the cost to serve customers has been coming down over time and is now at a very low ratio. That is exactly what you want to see. The average profitability per customer is going up and to the right. So they're getting more customers. Every customer that they have is a more profitable customer for the business as well. Those are all very good positions for New Holdings right now. Moving into some of their some of their slides, I wanted to show you something else. Sustained operating leverage. So are they doing good cost control as the revenues are scaling higher? As a matter of fact, yes, this is the efficiency ratio. This black line right here, this just represents how much of their costs, right, versus too much, what is their cost profile versus their revenue profile as well. So as you scale, you want your costs to be less and less of a portion of revenues, of course. And as you can see, that as well is moving in the right direction. As of right now, it stands at about 28.3% of the company's revenues is currently expressed in the form of costs. So this is moving in the right direction as well. So all ratios for this business really moving in the direction that I would want to see if I was a new shareholder. Now, another slide that could be very noteworthy for you is the return on equity of the company. This is something that you will often look at for financial institutions. You can see that the return on equity for the company is 28%. Very, very solid. It's following the revenue trajectory, following the earnings trajectory as well. Although they did have some quarters that were better than others, they're moving in the right direction, guys. High 20s, low 30s return on equity for a financial institution is amongst the best in the industry overall. Now, if I had to take a look at one last slide in terms of some qualitative data, you'll see here that in terms of Brazil, which is their largest market right there, they have 107 million customers. That is more than 60% of the adult population, which is being had by the company, or that they're exposed to roughly. Very, very strong, but they are growing in other end markets across Latin America. In Mexico, they now have 12 million customers, which is very strong. And even in Colombia, they say that they're approaching a major inflection point with nearly 10% of the country's population now choosing new. Very solid metrics overall. Now, if you were to compare this company against other fintech names or other banks, either whether regional banks in their location or other fintech players that you may know very well, like SOFI, here are just a few of the metrics. So here I've compared New Holdings, SOFI, and then a few different banks in Latin America, and then another one that we covered recently on earnings a few weeks ago, which is Mercado Libre, because we know Mercado Libre also has a fintech arm to that business. Now, return on assets, you can see here that New Holdings is very strong, 4.28, much better than SOFI or Itaú Banco and Bradesco, which are two other banks in Latin America, but not as good as the Mercado Libre right there. You can see the industry averages right here for banks and fintechs. 1 to 2% is the industry average for banks. So Itaú and Bradesco, which are more traditional banks, well, obviously, New Holdings is much better. And for fintech, they're at the higher end of the range, but not as good as Mercado Libre, of course. Return on equity, very solid, 27.88. SOFI only at 8.8%. So SOFI needs to do more. I'm a big fan of SOFI, and I'm a shareholder myself. The hope for SOFI is always that they'll be able to scale these metrics as it's still early in the growth trajectory. This company right here, New Holdings, has a lot more customers than SOFI currently has, so it's normal. But SOFI is currently playing catch up, right? Now, Itaú Banco and Bradesco, 20 and 12.35. You can see that New Holdings is much better, but still not as good as Mercado Libre. Now, NIM, which is net interest margins, which is very important for a fintech or bank, 17.7%. SOFI, only 5 to 6. The other banks, 5.5, 5.2. And unfortunately, Mercado Libre, we don't have a number right here. As, Mercado Libre doesn't, they did report it on their earnings. I believe it was, if I just recall by memory, it's about 8 to 9%. So unfortunately, Grok here was not able to put that together for us. But New Holdings is arguably the best of that bunch. Price to earnings ratio, you can see here, the PE ratios. That doesn't matter because in just an absolute term, you're not going to be able to derive anything good from that. We'll use the PEG when we look into it in just a few short moments. Now, price to book, another metric that you should be looking very close at when you're looking at banks. Traditionally, the fintech players are going to have higher price to book ratios than the traditional banks, but this one at 6.61, SOFI 4.15, and Mercado Libre a lot higher at 21.23. But don't forget, they have a whole e-commerce business as well, so that's not the best one right there. Revenue growth 14.2% per year, SOFI a lot higher at 43.9, and Mercado Libre in the middle there at 33.8. So as you can see, guys, New Holdings is keeping up with some of the best of them. They're much better than SOFI on certain metrics. They have more clients. They are either equivalent or worse than Mercado Libre on some other metrics right there. But I would say that these numbers objectively very nice when you compare them with other fast growing players in the fintech space, but especially when we compare them against legacy banks. So on to further analysis here, guys. Is New Holdings a decent buy right here now that we've gone through a lot of their metrics, expanding revenue very well, they're cost effective, and their operational efficiency is getting better. They're growing clients across Brazil, Mexico, and now Colombia as well. And they have a very decent portion of the population in all of their end markets. So is this company a buy, though, at $13 per share, where they currently stand? Let's have a look here at the price to earnings on a forward basis. It's a 22.8. You might think that that is very low, and you would be correct, especially since they are growing EPS at 35.5% on a year-over-year basis for as an average, right? Over the next 3 years. Take a look at their EPS chart, very solid, and take a look at their revenue chart as well, guys. They will be doubling revenue from this year through 2028. And in terms of EPS, they will be almost tripling their EPS from now through 2028. So a very fast growing company should be having some extremely attractive growth metrics for at least the next 3 years, which is a period of time where most of you might want to be interested in this company to really benefit from the fastest growth that a company could possibly have, right? So their PEG ratio right now, if we divide the price to earnings by the growth rate, you get a PEG ratio of 0.642. This is extremely cheap. If you compare this to something like a SOFI, guys, SOFI is a 1.35 PEG. They're growing revenue and growing EPS at very attractive clips too, but the PEG ratio is what really allows us to compare different companies on a common multiple. So that being said, this company is effectively twice as cheap as SOFI. So very attractive opportunity in my opinion. And as I said, they'll be 2xing revenues over the next 3 years. Now, here are some forward estimates in terms of price. If we were to just use their forward EPS as a guide for both 2027 and 2028, and we were to derive a base case scenario, which is pretty much considering that the price to earnings remains the same, even though they're very cheaply valued right now, let's just give them a similar multiple every year for the next 3 years. So that is your baseline scenario. At a 22 for 2027, you'd be looking at a share price of $22.66, which is 75% upside for the next 2 years. That's a very good compound annual growth rate, guys. 2028 base case, 31.24. A lot of the growth happens between 2027 and 2028. So you definitely, if you're looking to hold shares, these years, guys, I mean, this investment is a question of not right now, in the next few days or weeks. It's a question of the next 2-3 years. Look at the price targets here for 2028. 31.24, that is 130% upside. That's the base case. The bull case is even better, guys. Even better. So I'm a big fan of this company. I like their business model. They have very good penetration across their end markets, very good products, very good customer retention rates, and very good efficiency rates as well. As a result, I would be a fan of investing into new holdings, at least for the next 2-3 years, as they embark onto one of the fastest phases of their growth cycle. Now that they are scaled, it's going to be all about operational efficiency and really targeting, trying to keep doing what kind of SOFI is doing right now, pulling customers away from the legacy banks. They have the growth metrics to do it. I think the pricing is attractive right now. So if I were to build a position, it would be here all the way down to roughly $11, this whole accumulation range. As you can see on the longer term timeframes, this company has not done much. It's just been accumulating sideways almost, with some ups, with some downs, but largely sideways price action for the last year and a bit. So not a bad location to accumulate. I'll remind you, before people picked up SOFI, it was kind of doing the exact same thing, right? Accumulation sideways for a very long time. And then you finally see the breakout when people realize what they're looking at. I would not be surprised if new holdings can also be a pretty good 2x, maybe even 3x over the next 2 to 3 years. So that's everything I had for you guys for new holdings. Hopefully you guys enjoyed that earnings breakdown. Now that we're done that, let us dive directly into the technical analysis portion of the video. So starting off with the SPY, as per usual, you guys can see that we had a bit of daily consolidation, but once again, always remember who is in control of the higher time frames. Of course, it is the bulls. Your daily higher lows are still down here at about 620, so any extended pullback, we'll just be looking for a daily higher low for possible further trend continuation. One area we could pull back into in the short term is probably the previous highs, 638, into the 12 EMA as well. You can see the bulls have done a good job of riding this 12 EMA for a very long time at this point, for a better part of the last 3 months. If you take a look at some of your breadth indicators, it's been a bit choppy this week, but overall, we can see that they have been trending to the upside. Percentage of stocks above their 20-day EMA, is 52%. Not that bad. Not too bearish, not too bullish. Can still see a bit of expansion in terms of your breadth. In terms of percentage of stocks above their 50-day EMA, 56%. So also not too bearish, not too bullish. Can still see some expansion to the upside for sure. It's meaning a lot more market segments can participate in the current rally, meaning if your favorite tech names pull back, is there still some room for institutions to bid up the rest and uphold the markets? The answer is indeed yes. And percentage of stocks above their 200-day EMA, also not too bearish, also not too bullish as well. So we can see some further expansion of the rest of the market to the upside. So keep an eye, guys, on rotation. Rotation, not only, as I keep saying, rotation between the big sectors of the market, but also within certain components of the market. If you see the infrastructure names pulling back a little bit and some segments of tech, which have been left behind, such as some of the cybersecurity names, which are down 15-20% over the last month, such as some of the SaaS names, which have been down tremendously over the course of the past 1 month. Well, maybe if you're looking for some swing trades, you kind of try to have to go for some of those short-term oversold sectors. That is probably where you're going to have some of the best results if you're looking for some short and quick short and quick term swing trades, excuse me. Now moving into the weekly time frame on the SPY, you can see the analysis has not changed at all. The bulls are still wildly in control here of the weekly time frame. So even if we get the infamous daily downtrend and people start panicking, just always remember who's in control. It is your weekly bulls, and at this point still anything above 620, looking for a weekly higher low for further trend continuation. Not looking too bad at the midpoint through the month of August. Moving into the QQQs right now, QQQs down about 0.44. Who is in control? Well, it's obviously the daily bulls. Daily higher lows are still set down here at about 552, just looking for a daily higher low for possible further trend continuation. Shallow pullback for now. Keep an eye on how they react to this infamous 12 EMA. On the weekly time frame as well, not too bad. The bulls are getting some pretty good expansion. Big tech, for the most part, is largely playing along, and you are seeing some intra-sector rotation, some of the big tech names rotating amongst each other, but also between infrastructure and software, meaning between hardware and software, you are seeing some continuous rotation. So there's enough rotation there to keep the QQQs healthy overall. But even if we unwind here, right, daily downtrend, just understand what we're going for here. We're just looking for a weekly higher low. The weekly bulls are still fully in control, looking for a weekly higher low, anything still above that same 552 and the 12 weekly EMA. So essentially, the bulls have a lot of space to work with here. On to financials. Financials did not have that good of a day on the Friday session, down about 1%, but the bulls created a lot of space off these lows right here. So at this point on this pullback, we're looking for a higher low. For possible further trend continuation, anything above 51.20 should do it. We also have a lot of support below us. This entire area that the bulls have been playing defense in for a better part of the last 2 months, that is currently still support for your markets, and that is 52 down to 50.4. And I've been telling you guys about what my favorite names in financials were. It was not the banks, because the banks ran a lot. It was some of the names that have been left behind a little bit. Visa, we were commenting on Visa down here being an extremely good buy, and it turned out that so far it actually was. We were commenting on Berkshire as well after their earnings being a pretty good location to start bidding and accumulating the stock. It actually was. So rather than me chasing some of the banks that have been just stuck on their highs right here, JP Morgan, Bank of America, Wells Fargo, Goldman Sachs, Morgan Stanley, well, you gotta look broadly across financials. Where's the opportunity? And that's why I brought to you guys Visa and Berkshire as two of my favorite plays, and the buys so far are being rewarded. So congratulations to you guys if you were able to get in with a little bit of a piece of that as well. Moving on to XLV, healthcare right now, very strong day for healthcare on the Friday, but still no defined close above 137. However, this is a very strong weekly candle close. It's not the first time though. We got a nice one here back in the month of July. Sadly, it was unwound the very following week. Now that we are through all of the earnings, however, and we have legendary investors such as Warren Buffett taking a stab at this undervalued sector, we might just be able to see a bit of follow through. And we've been waiting for that, but still, it's not done until it's done. I need a weekly candle close above 137. Give me the engulfing move on the weekly, and now we can try and go for the weekly uptrend and go for the monthly bounce, right? Because we know it's been in a monthly downtrend accumulation down here in around the 50 monthly EMA, which I was telling you guys, right? Pay attention to these longer term EMAs. When you see an EMA that since 2011 has only been hit, what, once, almost twice, so I won't count it, twice for COVID, and now 3 times, and every single time it's coming down into there, it's been a good buying opportunity. Well, you have to know, guys, right? Go with the longer time frames. Go with historical standards. It's a great time to accumulate, and healthcare has been some of the weakest players in the entire market, right? In the past, what? 1 year total? So I'm a big fan of still building positions. No, we are not too late. We are still within the confines of the EMAs, still within support. And I do believe that any buys made here can see some very nice returns over maybe the next 6 to 12 months overall. So it's a longer duration play, but one that has pretty good risk-adjusted returns, because the risk right now is not very high. So although the returns are not going to be something like a Palantir, at least they are risk-adjusted decent returns. Moving on to SMH right now. SMH pulling back a little bit because of what happened with AMAT, but not losing any significant levels. Still in a very nice daily uptrend right here. Looking for a pullback, anything above 283, looking for a daily higher low for possible further trend continuation. We're currently back testing a lot of the former highs and the 12 EMA, so we will see. in the event we unwind, right, you would need to see a big engulfing move, loss of the 12, and a daily downtrend, something the bears tried to pull off here, but never got the follow through. If it does happen this time, we'll just understand, guys, who's in control, right? Obviously, still the weekly bulls. The higher time frames will always show you the key control factors, right? So anything above 278 would just be looking for a weekly higher low for further trend continuation. The cleanest one, in my opinion, is the SOXX. The difference between those two ETFs is just the concentration into the largest name. So SMH is notoriously concentrated into the top components here, NVIDIA, Broadcom, and AMD, whereas the SOXX is a bit more well diversified in terms of percentage allocation, but we can clearly see a level right here, 235 to 215. In the event we get a pullback again into this area of support, I'll be doing what I have been doing, guys, in the past roughly 4 or 5 weeks, which is identifying my favorite semiconductor names on pullbacks, such as Micron into support, such as ASML into support, all these very fantastic companies into support levels to play some short puts or maybe to build some longs in terms of longer duration swing trades overall. That is how I'm looking to play semiconductors myself. On to the Russell. The Russell still struggling with overhead resistance, talking about 232, down about 225, so not quite through it just yet, but the Russell had a very nice push overall throughout the week. However, not able to close a weekly candle above our infamous resistance zone. This one was problematic for the markets a few times. We only had one breach into the post-November period after the election when the whole markets ran hard, but you guys can see how tough of an area this has been for the bulls several times over the last few years. As a result, in the event that you get a fade away and use this area as resistance and have a little bit of an unwind here, you're looking for a weekly higher low, anything above 212.66, looking for a weekly higher low, and maybe they have to two-step this process again. Though the weekly bulls are still looking good, they really haven't lost the pattern in terms of the higher highs and the higher lows. So the VIX, we're going to be jumping over the VIX, guys, because not much happened there. Yields as well. So as long as nothing's happening for the VIX, I'll remind you, right? We don't really have any expansion. It's still a good location to be buying some leaps on some of your favorite companies that have been left behind. Not the ones continuously clipping the all-time highs with high volatility. No, the ones with low volatility that have been coming down for 1 month, 2 months, but have very strong fundamentals, possibly that had very strong earnings, but maybe didn't get so much love. That's the company you're looking for down there. And the yields are just doing nothing. I keep saying we're going to be trapped between 4.5 on the 10 and 4.2. And the 20-year yield, we are trapped between 5 and 4.7 until I see some meaningful breaks in either direction. Well, we can't really say that anything is happening. A lot of this structure will be broken probably after the Federal Reserve's meeting in the month of September. As a result, bonds still remain an accumulation trade. It's going to be slow. It probably will be a profitable trade, but you're going to need to understand that you have to view this with a longer term time horizon. Moving on to gold right now. Gold also really not doing too much, so I won't spend too much time on this chart. Still trapped between 3,400 and 3,600, which is resistance, and below support 33 down to 32.60. This is all about market sentiment, guys. Now that we have more certainty in the markets since the April sell-off, gold has done nothing. Right? Gold sometimes is an uncertainty trade. It's an inflation trade. So far, inflation, although on a slight uptick, has been running wildly out of control, at least not as much as the expectations for it were when we were rallying on gold back there. And there's also not that much uncertainty in terms of macro or in terms of politics, not as much as there was back here. So, right? So it's all relative. So as a result, gold has been doing absolutely nothing. The bulls still do have an upward leaning bias, but this trade is very, very challenging. So if I want to play gold myself, you're going to have to give me one thing. Either the break to the upside, give me the break, I'll play the retest, or give me the break to the downside, and I will play the back test for a further follow through to the downside. Monthly overbought conditions right now. So, you know, if it does break those weeklies to the downside, I'll be looking for that follow through to the low 3,000s. If it breaks to the upside, we're looking for continuation into 35. But right now, just try not get chopped up by this tight range here that we've been in for a better part of the last 2-3 months. That's everything for gold. And now lastly, Bitcoin. So Bitcoin unraveling as well on the Friday session. Thursday was a bad day. We clipped new all-time highs, unwound almost everything. The bulls still do control this time frame, though. It is a nice daily uptrend, although the bears did a nice job of retracing. That's a big retracement size, guys. That's like 78%. So it's going to be really tough for the bulls to just completely V-shape this. They can, but it's tough, right? Maybe something like a tightening range and then try it again, or the two-step recovery process like this. The V-shape is always the one that has the least amount of probabilities, especially with such a heavy retracement size. Keep in mind, though, if they unwind and crack below here, which is around the 117 level, if you unwind, you run the risk of doing this, the good old backtest and daily downtrend, and just go further into a bit of weekly consolidation. This period in time reminds me a lot of what happened here or what happened here, where the bulls made a nice little push into a level and just started accumulating again. The way that I'm playing this, though, is on any big red days, I am selling puts under the market on my favorite Bitcoin tickers, which could either be IBIT, which would be down here, low 60s. This is the former breakout zone, former all-time highs, or BITX. BITX down here in the lower $50 range as well. I'm a big fan of playing. Ethereum as well hit a local top and has just been consolidating ever since, but we know the bulls are still in control of this chart. Higher lows are right here at around 41.51, looking for a new higher low. In the event you unwind and go into a daily downtrend, is it panic time? Not really. The bulls have a lot of space, right? Anything at this point above 33.50, looking for a higher low. For possible further trend continuation down the horizon at some point in time, a likely area to backtest would obviously be this area that we just broke out of, talking about 4,000 down to about 3,700. This would be an area that it would possibly be targeting for more swing trade longs. That's everything for your overall market rundown. Now, let's dive into some of the big tech names, shall we? So let's do Apple first. Apple down about 0.5% on the Friday session. It was a pretty good week for Apple, ending up on the week, but unfortunately ending Friday on a sour note. The bulls are still definitely in control of this chart, though. We are currently above the resistance level slightly. That is 232 down to 215. I know it's a very wide zone, guys, but it's all the price action from before here. And also, it was an area that acted as resistance for the bulls for a very long time. So you got a lot of space to work with here on the daily and weekly timeframes. Anything above 201.70. Still just looking for a higher low for possible further trend continuation. That's if they don't do it right away. Apple is looking pretty good, though, whether on the daily time frame or on the weekly time frame too, looking very good. A lot of space. So any further declines on Apple stock, I will be a big fan of selling some put options, preferably into the low 220 region. 220, 218 would be the go-to location for me, and also building some further swing trade longs could be a decent opportunity if we do see some pullbacks on Apple. Keep in mind, in terms of the early weeks of September, that is when Apple is going to unveil the new iPhone 17 and various products that we will be looking forward to in Q3 and Q4. I'm looking forward to them, guys. I'm quite bullish on that rollout overall. It's been a long time that we've had a design change on the iPhone, and the specs of the 17 versus the 16 and 15 are a pretty significant upgrade. Moving on to AMD right now. So AMD down 1.9%, getting pulled back with the rest of the semiconductor industry, but who is in control? Still your bulls right now. We are still kind of grinding away at this 12 EMA, which we've been riding for a better portion of the last 3 months of time. That being said, the higher lows are set 168.50. In the event we cannot break above this infamous resistance zone, 184 to 170, you see it best on the weekly time frame. It was a struggle point for the bulls a few times in the last years worth of trading, right? So in the event that you unwind this entire move, set up the downtrend, and just are not able to breach resistance, you are going for a new weekly higher low. Now pay attention, guys. The higher low is well, you can make an argument of this down here, 158. So we're going to be looking for a bit of a slide down here. If that does happen, no problem. I'll be looking to sell some short puts down there. And also this will be my favorite location to add to some swing trade longs or any leap call options if we're looking to ride AMD into, the possible expansion for the next few years. I built this thesis on the channel all the way back here, and the thesis is still the exact same. You just need to understand what AMD is trying to do over the next 2-3 years of time. In terms of their EPS, they will be doubling their EPS. And in terms of revenue, they will also be doubling their revenue from 2025 through 2028. So I still do think there's a long road of upside for this stock. My price target for AMD in 2027, so not January 1st, but at some point through 2027, I would not be surprised if this stock is sitting at about $300 per share. I mean, it wouldn't be so egregious, guys, considering the fact that the valuation right now is still pretty good. On to Amazon right now. Amazon was roughly flat on the Friday session, but Amazon had a really nice push throughout the week with the news of expanding into the grocery delivery business. Daily uptrend is now controlled by the bulls, and any pullback, you're looking for a higher low, anything above 218, 219, looking for a new higher low. And now, indeed, since we did close above this zone, I can change this box into a nice, big, beautiful box of support. Let me just do that right now. So as we can see here, daily time frame, lots of support below. The EMAs are sitting below us too. Could be a very nice breakout, retest, and run trades. So in the event we retest down here, very simple, the stop loss goes below the support region, and then thereafter you are targeting expansion into the highs being 243, 250 psychological as well. The weekly bulls have never lost control, which is why we retain a upward bias, looking very strong. The weekly higher low is all the way down there, 211. So in the event they can't get it done in one clean motion, and they have to do it in 2 stages using support to their advantage, it could be a very nice reload opportunity. Amazon's still one of my favorite stocks into 2025, 2026, 2027, 2028, and beyond. It's my largest holding for my long-term portfolio. On to Google right now. Google having a very good week as well, but unfortunately on the Friday session, they pushed up about 1%, gave half of it back, ending only up 0.5, but still very strong push by Google. Looking pretty good right now, guys. The daily higher lows are established right there at about 198.69, so any pullback, you guys know the drill. Looking for a new higher low for possible further expansion and trying to breach the infamous all-time high resistance zone. If they cannot get it and you see an unwind, what are we looking for? Well, of course, you're just looking for a new higher low on the weekly time frame. Should make perfect logical sense, right? Now, the higher low section right here is anything above 173. Looking for a new weekly higher low for possible further trend continuation right there. And the fallback location is down here, 195 to 185 roughly. If we pull back, this is where I will be either going for more swing trade longs or also where I will be selling some put options in the open market. Now, the valuation down there at 190 is very, very attractive for Google, so it could also represent a good location to add more long-term shares. On to Meta right now. Meta up about 0.4%, but you can see it's been very choppy since the earnings, right? That being said, pretty good expansion leg right here. The daily higher lows are set at about 759. So we're just consolidating right now, consolidating above these previous earnings highs. A bit choppy price action on the daily. In the event you just go for the straight expansion, you are going right into 800. And then the next psychological targets, guys, 825, 850, etc. In the event you unwind the daily downtrend, do we panic? No. The weekly time frame shows a lot more clarity for Meta right here. The weekly bulls are in full control. The weekly higher lows are right now at 692. You would just be looking for a classic retest of the possible prior highs, which right now currently stands at around the 740, 730 level. The weekly 12 EMA could probably be catching up. This would be a nice reload area for some Meta swing trade longs. No swing trade positions from me all the way up here, but if we do drop down there as well, maybe some swing trades, but also maybe adding to more long-term shares, as the valuation of Meta is not too bad all the way up here at the 740, 750 range. On to Microsoft right now. Microsoft down about 0.4%. Watch out for it, guys. Right? We've been commenting on this for a while. If Microsoft loses the 12 EMA that they've held for 3 months, and in combination, we get a daily downtrend, which we currently have, if it perpetuates, you guys know what's going to happen. We're going for weekly consolidation, right? Where could we maybe end up? Well, maybe back down here, 495, which is the weekly EMA. But unfortunately, the bulls did not set much support on the way up. So this is just a tentative level. It reminds me a lot of Netflix, which we're going to be looking at in just a minute, guys. So use this chart and then go to Netflix and see what happened when Netflix started their consolidation period. It's a good thing, though, in terms of market performance. If we look at year to date, if Microsoft chooses to take a little bit of a breather, do we have other names that have been left behind that can pick up the slack? Yes, we do. We have Apple, we have Amazon, and we have Google as well. So please keep that in mind. But Microsoft right now, on the edge, on the edge. So no swing trades for me right now, neither long, neither short, and also no long-term positions for me because the stock at about 520, I mean, it was pretty fully valued. I know I did the valuation here at 550, but it's only really what, 5% lower? 5% lower on these multiples is not really going to change the fact that Microsoft is fully valued right now. So Microsoft for me remains a hold. Moving on to Netflix. Netflix, this is what I want you guys to realize, right? Watch what happened on Netflix here. Apply it to Microsoft. Loss of the 12 EMA and daily downtrend, and you embarked into a 5-week period of consolidation. They broke the 12 EMA slightly, and then they were able to get it back. So obviously no two charts are going to be the same, but just some points of reference for you guys to understand. Now, Netflix is doing well. They have now recaptured the daily uptrend, which means that weekly consolidation is now finished. So what you'll be looking for here is you want the bulls to keep this going as long as possible to retrace as much of this weekly move as possible. Why? Because we lost the weekly uptrend. They flushed the lows. So now the bulls need to get it back. It all starts with the size of a bounce. The size of the bounce on the weekly right now is okay. It's a 50% bounce. Give me a bit higher, moving into 1275 or higher than that, 1300. And then you can say, okay, the bulls have a very nice size bounce. When we do get the next leg of consolidation, the likely scenario is going to be for a new weekly uptrend for the bulls. Right now, stage 1 is set. They have the daily uptrend looking not too bad. Overall, though, as well, for Netflix, guys, the valuation right now is a little bit towards the top. So Netflix, for me, remains a hold right now. You might remember I was saying that I was adding shares on this location right there, but it was a tiny nibble. A tiny little nibble for me. And of course, if we unwind this weekly, because that's always a possibility, you're going for more monthly consolidation. The likely area would be down here about $1,100, $1,000, closer to the 12 EMA on the monthly. And the monthly has been tested by Netflix many times throughout this massive rally. So a pullback to there would not look so awkward, would it? Moving on to NVIDIA right now. NVIDIA down about 0.86%. Well, I mean, just look at Netflix, guys, right? NVIDIA is the same concept. It's been holding up very nicely right now, but the bulls might be just getting a little bit tired. We will see if they can muster up another leg and pull us into 190 or 200, but pay attention to the 12 EMA. As of right now, it is still a daily uptrend. Very nice. They're going for the higher low, anything above 170, looking for a new higher low for possible further trend continuation. They've been grinding the 12 this whole time. So if they lose the 12 and lose the trend, kind of like Netflix did, you're going into very healthy weekly consolidation on NVIDIA. That wouldn't be the worst thing in the world. Now, the first location for a touch would be around 162. The massive support only starts down here at the lower 150s, so keep those two levels in mind in the event that we do pull back in a swift and aggressive fashion. That'll probably be where we go. NVIDIA has earnings in 2 weeks, only in 2 weeks. So maybe we don't get such crazy volatility into earnings. Earnings is probably going to be the big catalyst. Usually NVIDIA moves 7 to 10% after earnings. So maybe what? Maybe we just stay maybe sideways and range bound a little bit until earnings. I'm not expecting some really big declines on NVIDIA before earnings, but maybe I'm also not expecting a massive second leg of rally here, pushing another 10% prior to earnings as well. So those are just some expectations to go forward. Moving on to Tesla right now. Tesla down at 1.5%, but we were clearly saying it was getting rejected at resistance, guys. 360 down to 340. There was a swing trade entry here that I know a lot of you took based off of the analysis that we did on this channel. They broke through, right? They broke through this tightening wedge right here. Very nice tightening wedge. You can call it a bull flag as well. Weekly uptrend cracked into the overhead resistance range, and now just pulling back to where? Well, maybe into all of the EMAs and maybe into this downtrending top end of the rising wedge, right? Or rather, not the rising wedge, but just in terms of the wedge or the bull flag. So looking not too bad right here, guys. Looking for a new higher low. Maybe 320, 325 is where the bulls really need to play a lot of defense. No swing trades for me right now, but in the event that you are looking for some follow through, they really need to stop it there and then go for the further expansion. If you unwind this entire move, it's not that big of a deal, but you might get another entry opportunity down here, kind of like Apple did. You might remember Apple here. They did the same thing. They smashed through. They tried to hold and go for expansion, but earnings was the unwind factor there. If it wouldn't have been for earnings, maybe you could have gotten to see the completion of that pattern into resistance. Tesla does not have earnings, so maybe they're actually able to do it. No swing trade longs for me on Tesla right now, but I've had to position here. Well, the stop loss would go down below here. It'd be very wide right now. Very wide trade, guys, right? A stop loss of about $20, and the upside from 320-ish would be the top end of the resistance range, right? Call it 360, because you're going for the weekly trend expansion and the expansion beyond resistance overall, but still no swing trades on Tesla for me. I think there are clearer charts in the market right now. On to Palantir. Palantir down another 2.13%. Obviously, there was a short report put out back here by none other than Citron Research. I'll remind you, Citron Research had a short back on Palantir all the way back here in 2021. So they haven't shorted this company in a very long time, but now they have position for a possible short on this stock, which is causing a little bit of volatility in the share price. That being said, who's in control right now? Well, it's obviously the bulls, anything above 151, looking for a new daily higher low for possible further trend continuation. But watch out. If they pull back too much, talking about a 618 or a 782 retracement size, well, then the bulls will have lost a lot of momentum, and you could be running into a situation where you just establish longer form consolidation, or at worst, you run into the daily downtrend. If you get a daily downtrend, the bulls have a lot of space on the weekly timeframes, anything above 129, looking for a new weekly higher low, and sadly, the 12 EMA is a good distance below here, guys, talking about like 160, 155 by the time it pulls back there, so it could be a if it does happen, that would be a decent sell-off on Palantir right there. Long-term fundamentals of the company are still overvalued, as you guys really well know. The technicals of the company are still very overvalued, as you guys know, on the monthly, on the weekly, the daily now a little bit less, but still everything is very overbought right now. It's very tough to start a swing trade long up here. It's very tough to start a position up here for some long-term shares unless you guys have a 5+ year time horizon. The numbers wouldn't really make sense for you. Moving on to SOFI right now. SOFI up 2.06%. A lot of volatility on SOFI recently, but the trend is very clear right now. It is simply a nice daily uptrend, right? The higher lows are down here, 20.71. Matter of fact, it's this whole area, right? 20.7, 20.5, looking very strong overall. So in the event we get a pullback, they're just looking for a daily higher low. Anything above these guys, higher low for maybe finally smashing through the resistance range right now. We are still trapped within resistance, which is 24.50 down to 22.50. SOFI is not looking too bad, though. The bulls look like they really do want to go for it. Maybe one extra week, and we might just peek our heads above, which would free up another trade opportunity. Breakout, retest. I'd be a big fan of playing that retest level. In the event that they cannot get it done, and we just slide from here, I'll be looking to sell some puts down here in the lower $20 range. For a longer term position for SOFI, if you're looking for the expansion of the market cap, expansion of the client base, expansion of the product suite over the next 3 to 5 years, SOFI is not that bad of a buy up here. I mean, it was much better when we were talking about it here. It was also a little bit better in the 20s. At around 23, it's still manageable. The company's market cap right now is just shy of 30 billion. I would not be surprised if over the next 2, 3, 4 years, this company is able to expand into a $35 billion company, $40 billion, $45 billion company. So the compound annual growth rate should be pretty decent for SOFI. Obviously not as good as people who got it back here, but still, you could see some pretty decent upside on this company. Moving on to Uber right now. Uber up 1.31%, but the price action on Uber is very, very choppy ever since earnings. You can see a wild range of consolidation right here. It's resistance, right? That's why it's so choppy. 93 down to about $90 is going to be that resistance range. In the event that you are unable to break this and move a little bit lower, you'd be looking for possibly a revisit of these lows, maybe a weekly downtrend, and just maybe further monthly consolidation. The monthly chart is the cleanest chart on Uber for me. And if we do get a pullback here to the lower 80s, talking about 83 to 77, it would be an area to reload some longs for swing trades, an area to also load some longs for a longer term portfolio as well. I do have Uber in my long-term portfolio, although the last time that I was buying Uber was in this consolidation phase. But right now, it's not a very bad proposition. In the event you get the breakout, you guys know the drill, right? Breakout, retest, stop loss, and then go for the expansion, $100 psychological. That would be a clearer type of trade for me. Moving on to TSM lastly right now. So TSM down off the highs, but still no new all-time highs. 247 has been an infamous area of resistance for the stock pretty much since after earnings. It's been almost a month that they've just been trapped in this wide area near the all-time highs. The cleanest time frame for me on TSM, because this is very choppy price action, guys, a lot of gaps, a lot of choppiness, is the weekly. This is just sideways weekly accumulation with a bit of a downward bias. In the event that you do fall back, what are we looking for? Anything above 206, looking for a weekly higher low. Where could we pull back into? Maybe the 12 EMA right here, 226, or the former highs around 220. That would be a decent little price action sell-off right there. And I would be looking maybe for more long-term shares down here, but also maybe to run the wheel. If you pull back a couple big red days in a row, you might be able to find some juicy opportunities to run the wheel, selling puts under the market. Under 220, that would be a likely area that I would not mind. And for long-term shares as well down there, not too bad. At 245 even, the valuation is pretty decent. Fall back down to 220, it becomes a low 20s multiple. So a decent time to add to some long-term shares. Fantastic company. Obviously one of the companies with the largest competitive advantage in the entire world in terms of semiconductors, guys. Nobody can really produce the quality of chips that they do at the scale that they do as well, right? So very strong company, one of my favorites in the semiconductor industry. And there's the only two equipment companies for semis that I have in my entire portfolio. TSM and ASML. Those are the only two as part of the manufacturing side of semiconductors, right? Now, that's pretty much it for your big tech list. So we won't be doing the biggest gainers and losers of the day today. I covered a ton of them throughout the week. So we went through so many different growth companies. I'll refer you to those videos towards the end. We'll be doing them in the next following week because we don't have that many earnings coming up this week to cover. Palo Alto Networks, Home Depot, Toll Brothers maybe, Target, TJX. That's pretty much it. Then on Thursday, Walmart and maybe Intuit, maybe Workday. But you can see we're going to have a lot of extra time this week to go over the biggest gainers and losers of the day. Today, what I'll do is a deep dive of the portfolio, which we usually do on the Friday or Saturday recap videos. I'll spend 10-15 minutes recapping all my trades, why I took them, why I either took them, I took profits on them, why I'm keeping other ones into the next few weeks. So we'll be going through the portfolio right now. Let's do that immediately. Okay, so in terms of the weekly performance, which trades did we close this week? Well, as you can see, we had some very good success on the wheel as per usual. Oscar Health, HIMS, AMD, BITX, HIMS, Figma, and SMR, all plays that I was commenting on in last Sunday's top 5 options video. So you can see a lot of very decent wins at the exact same levels that I was telling you guys I wanted to play. Oscar Health all the way down here into our support, 14.5 down to about 12, decent play. If you take a look at the other ones here, you have HIMS. I've been saying that with the volatility, we can find some pretty good strike prices in around the low 40 range, above, slightly above 40, under 40. It's usually a decent area to play. AMD, I was telling you guys I would play every single pullback on AMD. We got a very nice chance early on in the week talking about the Tuesday session, good volatility intraday, and we were able to find a very low 160 strike, which is roughly the bottom of the earnings candle. So I played AMD right there, made some nice little profits on that one. I rotate these positions fairly often, which is why you're seeing me close them early. BITX, been commenting on BITX. I love playing the mid 50 zone. That will not change. So we got a nice win there throughout the week. HIMS as well, another trade. There were 2 trades on HIMS this week, both of which winners. Figma, I was telling you guys that the only way that I'm playing Figma is not going for some longs. No, I will play the volatility, and I was able to find a very deep strike price into the $55 region, 28 cents, which is 0.5%. We closed that a bit early to free up some capital for some of the lottery earnings trades that I took as well. And SMR, I've been talking about this one a lot. SMR, very big pullback, very volatile pullback. And my favorite area to play this one is the low 30. So I played a 32 last week. Coming to this week, we'll see what we can get, maybe high 20s. I wouldn't mind doing that for the whole pullback area on SMR, looking for some monthly consolidation overall on this retail fan favorite nuclear play. In terms of the assignments for some positions, well, we have a CoreWeave position. I'll show you guys what I did with the CoreWeave after, but in terms of managing the existing positions, Sentinel-1, some covered calls. We got assigned on them just last week, so we were able to write some 17.5 covered calls on Sentinel-1. So Sentinel-1, very easy trade right here. Lower end of support down here about 17, down to about 13, 14 bucks. In the event it continues to slide, I will DCA the position with some more short puts down below. But overall, the company's trading at a relatively cheap valuation, one of the cheaper ones in cybersecurity right now. And in terms of the total price, so I keep an assignment tracker of all my assignments. You'll see here that we got assigned with some credit. We wrote some credit for the covered calls, and now our cost basis on Sentinel-1 is $17.05. So we're not underwater too much on this one at all. Now, CoreWeave is a contract that sometimes you guys ask me, when do I roll down short puts? I'll only roll down short puts if I can get a very big discount for a credit. So coming into after earnings here on the Wednesday session, guys, I wrote some CoreWeave puts for Friday for 110. Now, coming into the Thursday session early, there's a lot of momentum to the downside, and I chose to roll my short puts from 101, or excuse me, from 110 down to 101. So you'll see here that if I go on the, the weekly recap here, we had the 110 put for 78 cents. Very nice credit. I was able to roll it into this week for 101, rolling it down for free, a whole $9 extra, and I got a 50-cent credit. Looking very good. If I get assigned here, my average cost will be 99.72, slightly below the current share price. So we will see how it goes on CoreWeave. If I get assigned, no problem at all. The covered calls are extremely juicy. My DCA on this one has to be below 80. So I'll take this one 1 week at a time, but just making the best out of the current volatility in the markets right now. In terms of our directional trades that we closed, Rocket Mortgage. Rocket Mortgage has been a very big winner for us. We entered the leap calls somewhere down here into the $12, $13 region. We closed one when it was about 2x here. And now we closed our last one at the top, almost of this candle right there, for 3x. So 200% gain on Rocket Mortgage. In this account, I'm now out of Rocket Mortgage calls. I still have a few in one of my tax advantaged accounts, but I'm keeping the other ones through 25. But in this trading account, we're fully out of that Rocket position. As I said, a nice 2x on the first contract and a 3x on the second contract. Lottery trades. We had one CoreWeave short put for 90. We were able to take profit on that. And we also had some of the critical minerals plays, which I've been talking to you guys about. USAR, twice we played this one, both for very good profits. And one we played quadruple U. So those are all, so this is USAR. I don't mind playing pullbacks here, guys. This one's very volatile. Pullbacks in here, a very logical area to go maybe placing some short puts. If I get assigned some shares, I'll just hold them because this narrative is going to be probably favorable for the next few, I assume the next few weeks and the next few quarters as well. And even quadruple U's here, previous resistance, current support. So I'll be playing there. If I get assigned some shares, I might just hold them and go for possible expansion of the critical minerals sector, which is obviously led right now by MP Materials. These other ones, guys, we're just looking essentially for possible government subsidies for these companies to scale up production as the US wants to reduce its reliance on foreign critical minerals. So this is just a thematic play overall. So that's it for the position recap. In terms of the active positions that we currently have in the portfolio, you'll see that I have a few assignments still. Talking about Amazon, Chewy, and Fiserv, right? And we already went over Sentinel-1, but Amazon, we are likely to be called away this week. I got assigned at 220 a few weeks ago after earnings, and now we might just be called away. What's the total average cost on Amazon? Well, we got assigned at 220, and now we've been running covered calls for the last 2 weeks. Our average cost is 213.36. If I get called away this week at 220, I'll get my buying power back, and we'll have a very nice weekly ROI average on this trade. I would not mind being called away. The other one right now is Chewy. So we got assigned at Chewy on Chewy at 37. We've been doing some good covered call trades right here, and the average cost of that Chewy trade right now is 35.72. If I get called away at 36.5, right, I'll be making roughly 0.5% per week for the better part of the last 3 weeks, 4 weeks since I've been in this stock. So this one too, this one and the Amazon is largely respecting my 0.5% per week rule. So if we get called away on both Chewy's been having a really nice run recently, guys. Take a look here, right, on both Amazon and Chewy. Amazon's above my 220 location for covered calls. I would not be surprised if I'm called away this week. Chewy is well above my 36.5, so I would not be surprised if I get called away on that one as well. So that being said, we've made a good job. We've done a good job on trading the wheel on these two companies. If they get called away, I'll get my buying power back. Here you can see Duolingo. This is a new position that I started about midway through the week. Just some shares, though we bought into about 322. We covered this one for earnings, and I found some decent value on this company. Really unfavorable after the ChatGPT version 5 came out, essentially, with their live translation services and whatnot. So that being said, it's pulling back into a very nice area of consolidation. I'm a big fan of adding some shares here and or down here, 300 down to 270, building a bit of a position. We were commenting on the fact that the compound annual growth rate for a swing trade, this is a long duration swing trade, guys. I'm not expecting to get out of this one in the next 2 weeks, but next maybe like 3, 4, 5, 6 months type of thing, going for the recovery of the stock. I'll build a little bit of a share position. The options on Duolingo are a little bit expensive, and so as a result, I'm playing this one with shares. The other trades, I mean, Restoration Hardware, you guys know this one. This has been like my meme play, but it's not really a meme play. It makes perfect sense. This is consumer financing in a nutshell, right? So as interest rates come down and financing becomes more attractive, Restoration Hardware may get more business. So my cost basis is 220 on the shares that I do have. I'll be targeting the upper bound here into the 300s and maybe a little bit higher to offload that position. It's a very small position for me, guys. It's just a trade idea. We've been in it for a few months right now. We're now into profit on that one. I think we talked about pretty much everything else. The long call options that I still have, Affirm, the 110 leaps are still underway, and we're still up 120% on those. I'll be taking profit on those if they come into close to my strike location, 95, $100. That's really my profit target on Affirm currently. Looking for the expansion on the longer term time frames of this one, guys. Look at the weekly candle close on Affirm. Very strong. I'm looking for the monthly expansion of this chart, possibly back into the $100 psychological range. Very strong company with very strong numbers. We covered it in terms of their earnings last quarter. We'll be covering their earnings again when they come up in about 2 weeks worth of time. So the Affirm calls are doing really well right now. A lot of my Discord members have multiple of these contracts. And as I always say, when you're up over 100% on call options, close half, make the position free, and then ride the rest, especially when you have a lot of time on them. KWeb, our calls are finally starting to come alive a little bit. You can see our average cost is under 4. Their contracts are now at $5. We're up about 26% on those. Not a bad trade as well for KWeb. I'm just looking for the expansion of the China trade overall. We got a lot of time, January 2027. And what I'm looking for as well is the infamous monthly expansion of this chart. It's a slow moving chart, but one that has a bullish leaning bias right now. So I'll be looking to this index overall to expand into the 40s. Same rules apply. If I do see 100% plus at one point, I'll wind down one contract, make the trade free, and then ride the rest. Oscar Health, new position, January 2027, $20 call options. These right now are up a little bit right now, about 10%, which is very good. Since we have Warren Buffett now playing the healthcare sector overall, I mean, I got into this one before I even had that news right here on the back test. The breakout after earnings, the back test of the support range, I'm just looking for possible continuation. If it doesn't happen and it just consolidates here a bit more, perfect. I'll add another one down there. But what I'm looking for is eventually, right, this consolidation to turn into some form of a slight uptrend. I'm targeting the top end of the range on Oscar Health. It's a very small contract for me. Like I said, I started off with 1. I might be going up to 2 or 3. We'll see how it goes. Sentinel 1, same concept. Sentinel 1, $20 call, January 2027. This is a leap. We're currently up on this one at 10%. This one was also started this week in around the lows of the week, right around down there. And now we're just looking for the recovery of cybersecurity as a whole and Sentinel-1 perhaps as a whole, as now we're coming down into the last 2 years worth of support. I'm just looking for expansion into 20 and possibly into the $30 location at some point over the next 6 to 12 months. So not looking too bad there. We also still have the TLT calls. I have not DCA'd this one. I've been in this trade for like 4 months at this point. No DCAs yet. I'll look to get closer and closer to the September rate meeting to do that. We have XLV as well. XLV, I added to this contract this week after Eli Lilly earnings. So I was waiting for Eli Lilly earnings and most of the healthcare earnings to be out. We added to this one here. And now we're currently up a decent little amount. You might remember my first buy was, I'll tell you guys, it was June the 2nd. We burned like 2 months worth of time. The contracts bled a little bit. And then we added a second one down here. Our average cost on these 130 healthcare calls is currently 13.8. And we're currently up 16% on that position. In terms of the short options, guys, I mean, all of these, most of these are just covered calls. We talked about CoreWeave already. The other ones are, I think, SOXL. SOXL is a new open position for next week, 23.5. We got 0.5% for that on the semiconductor pullback. I've been telling you guys, I enjoy playing SOXL, 21, 22, 23. So that's another one of those. And Walmart. I tried to play the Walmart pullback the other day, hoping I could get out before earnings. They have earnings on Thursday. I have the 97 strike, which we got for 96 cents. We're currently underwater a little bit on this, but I'm playing this area of pullback for Walmart. Okay, that's all I'm doing is I'm just looking to play the slight area of pullback. Obviously, the larger area of support is down here, 94. If I can see a little bit of a pre-earnings rally on Walmart, I will seek to wind this contract down. I got into it here after the Amazon news, hoping we might get an instantaneous bounce and follow through into earnings. It did not happen. We are slightly underwater, but I mean, how much are we down, right? Not that much. In the event that I'm still in this contract before earnings and we have not moved, I might just wind it down for a tiny loss if there is one, and maybe I might just reset for a lower strike into earnings because I don't really want to hold this into earnings being kind of close if I don't have to. So I was trying to play for a short duration swing trade. It didn't happen. We still have a lot of time before earnings, 3-4 trading days. If we have a bounce, we'll be able to get out. If we don't get a bounce, I'll probably just either roll it down to a lower strike closer to the larger area of support overall. I think that's pretty much it. FISRV right here. We have the covered calls, 130 covered calls. So FISRV, sadly, this is a trade that we got assigned after earnings. That's why I tell you guys, you could do very well if you just play the wheel and just don't play earnings. Sometimes you guys see me play earnings, and for the most part, we got a lot of success when we do play earnings, right? You'll see that a lot of the earnings, the lottery trades down here, they work. Previously, they worked, but now look, one big loss on Trade Desk because it blasted through 2 and even 3 standard deviations. Prior, we had some small losses on earnings. For the most part, when you guys see my earnings trades, a lot of these lottery trades are earnings, short puts for earnings, right? The win rate of them is very good, but it only takes one. I'll go back to last season as well, just so you guys don't see it's a fluke right here, right? So a lot of these lottery trades, a lot of the lottery trades work out well. Sometimes you result in small losses, but a lot of them, they work out very well. Now, FISRV was one additionally. I usually play earnings 2 standard deviations below the expected move. This was another 3-4 standard deviation move, similar to Trade Desk. And sadly, FISRV right now is sitting in no man's zone, right? It's no man's land. The support area is actually down there, 120s to about 110, and overhead resistance here is 147. I got assigned at 146. I've been trying my best to farm covered calls this entire time, but the stock has just been wildly out of favor. As a result, midpoint last week or 2 weeks ago, I made the decision to play defensive covered calls at 130. Why? Because I don't want to hold this one naked and have it come down into the actual support zone. There's nothing here. There's literally nothing there. As a result, you always want to manage the risk first. You do not want to let things slide down another 10% if you don't have to, especially uncovered. So if you want to see my average cost on Fiserv right now, after a few, covered call positions on it, the average cost is 138. If I get the covered calls for 130 are for this Friday, I will see if I can roll them forward and keep collecting premium, but I'm not opposed to winding this position down at a loss, taking a loss, and maybe replacing it with something that's more capital efficient, such as a leap call option. Instead of keeping $13,000, $14,000 into this trade and seeing it being very choppy and being dead money as no one seems to buy this one before it comes down into support, well, I can get a leap call option for a fraction of the price. That is what I will do if I'm going to be called away on Fiserv. We are just going to go for a share replacement strategy, something like a January 2027 call, and I might just be looking for some at the monies here for about $3,000. Good leverage, good amount of time as well on the contract for some possible recovery, but at least I can only have $2,800, $2,900 in that trade. Instead of locking up $13,000, I'll be able to free up $10,000, $11,000 extra dollars that I can go play other things with, and rather just keep a call option instead of, trying to wheel my way out of them, since we know it's unfavorable on all time frames. Monthly, downtrend. Weekly, downtrend. Daily, still a downtrend. So until the trend changes, the bears are still in short-term control. So I'm not going to try to guess. Maybe I should wait until it goes up here to write some covered calls. Maybe I should just not do anything and just have it unwind on me, right? No, we don't speculate. We just do the best that we can with the levels. If I have to take a loss on this one, I'll be heavily exploring either some pure leap call options or even a leap call debit spread to reduce my cost a little bit more. A leap call debit spread could be something like a 135 call. Then you cap it with something like a 220 call, right? That would only cost you, roughly around, let's call it, $2,200, which is a very low amount of money to stay in Fiserv. I still love this company, but if I can be in it for less money and still have the same upside, I'd rather do that instead, right? But the moral of the story on this one is, once again, this loss, if I do have to take it, and the other big loss that we've taken recently running the wheel strategy, they have one thing in common. They were both earnings trades. And I always tell you guys, just don't do earnings trades if you don't have to, right? They help sometimes to grow a small account. You have to take on more risk. And you guys know I started off this account earlier on this year with about 45, 46K. We're pretty much there right now because of the tariff sell-off, of course. So we were down at one point 30% because I went max margin all in on the tariff trade. It didn't work out. And I was telling you guys, we'll be able to make it back just consistently trading. Sometimes when you have a small account and you want to grow it fast, you have to take on more risk, right? Especially if you want to grow, a mid 5-figure account into a 6-figure account, whatnot. You have to take more risk than someone who already has a 300, 400, 500K account, like my other big trading account has, right? So that's essentially the risk that I take sometimes for earnings plays. But you guys, if you guys have big accounts, you don't need to take earnings risk. Matter of fact, I always say it on the channel. If you guys just want to avoid awkward, weird losses, just don't play earnings. The only two big losses that I've had in the recent 2-3 months of trading anything related to short puts have both been earnings trades. They've been this one, which is Fiserv, and then they've been Trade Desk, of course, right? So keep that in mind. Other than that, other positions in the portfolio that are noteworthy to mention, we have a new call debit spread on Airbnb, targeting the 135, and a new one on PayPal as well. Very logical plays right here. Number one for PayPal, we're just looking for the daily uptrend out of support, just looking for a bit of weekly action to bring us up into the mid 70s location. Company's still right now a bit undervalued, and it's a long standing support range. I put a lot of time on that contract as well. And Airbnb, you're kind of looking for the same thing out of a 2 years worth of support range. We were kind of daily oversold right here. We got the daily uptrend back. So we entered this one here, and we're just looking for a bit of follow through into our strikes. So those strikes for Airbnb are November 130, 135s. PayPal's are a November 72.5 and 77.5. All the other ones you guys are really used to by now. Adobe, we're still waiting for the software recovery. CRM, we're still waiting for that recovery too. Berkshire, we've been in this one for a month and a half. Haven't added to the position at all, but we're still waiting for it to recover by October. ASML, we did add to this position. It's recovered a little bit, but still nothing meaningful for us right now. And then we have the bigger leaps, right? So the biggest, though, all the call debit spreads, a lot of the profitable ones, I wound them down the last 2, 3, 4 weeks. Now we're just holding the ones that went unprofitable. There are not that many of them. By far and by large, our long-term call options and the weekly wheel premiums that we make, they've largely made up for all of these call debit spread losses. You remember on the channel this year so far, I don't know how many call debit spreads we've done, but it must be like 40, 50, 55. I think we've only lost a handful. So that being said, the remaining ones that are still a loss, Adobe, ASML, Berkshire, CRM, those are still the ones that are lost. This Fiserv one is just an earnings lottery trade. So that's not really a swing trade per se. It was just a lottery trade for 130 bucks. It's been dead ever since. The biggest ones though, the bigger call debit spreads, the leaps, which I tell you guys to focus on, Amazon leap, 44% up. The Google leap right now, 67% higher. And the Micron leap, currently still up 142%. So that is the total standing for the portfolio. A lot of buying power will be freed up this week by having either Amazon, Chewy, Fiserv all called away. That's going to be good. We'll see what happens with CoreWeave, of course, the 101 puts. The SOXL puts are still active too. And other than that, guys, the rest is just long duration options that are running and a few new positions. So I do have some buying power to go shopping this week. But for the most part, I'm pretty much locked and loaded for several thematic plays and other plays that I'm keeping for the long term. So hopefully you guys enjoyed this recap in today's video. If you have any questions, please feel free to leave them down below. Other than that, consider dropping a like on the video. Would appreciate it for the growth of the channel. Consider subscribing if you're new. We do these every Monday through Friday after the close to recap the day. And last but not least, guys, if you guys wanted to join our trading and investing community of over 200 different members where we trade the markets every day, but we also build very high quality long-term portfolios. The link to join our community is down below in the video description. What do you get as part of the community? You guys get access to all of my trades, whether it's the wheel trades, whether it's the longer duration trades, such as call debit spreads, leap calls, swing trades with shares. You guys get access to all of my trades. Here's a lot of the trades in the last few months. The red little circles are losses. The green check marks are wins. And if you notice, a lot of my guys, they don't play the earnings trades. They don't play the lottery trades. You'll see a lot of the losses here are always the lottery trades, but just focus here on the directional trades, okay? Or the wheel trades. Here's all of them in the past few months or so, okay? So the green check marks are wins. The red little circles are losses. You'll notice where most of the losses are, right? They're the lottery trades for the most part. And then occasionally, some call debit spreads, small ones that don't work out. So those are pretty much everything that I had to show for you guys in terms of the trades. In terms of the live streams, you get access to our private morning live streams every Monday to Friday, where I trade live in the morning for about 2-3 hours at the open and take all your questions on your stocks, your options, and your long-term portfolios. You also get access to our chat rooms where you can ask me all your questions all throughout the day, and I'm very happy to answer. You get access to our private video section where I go through different options trading strategies, whether it's leaps, debit spreads, credit spreads, and a whole different other version of the wheel, especially if you have a large account. A lot of our members really enjoy the what I call large account wheel strategy that I never show on YouTube and probably won't ever will either, just for our exclusive members in there, and other educational content such as technical analysis, fundamental analysis, and a whole bunch of other things, how to build a long-term portfolio, how to scale a trading portfolio, whether it's a small one, medium one, large one, which strategies should you be running depending on your account size. And last but not least, you get access to all my charts. You can just copy paste all my charts, such as this. You get all the support resistance levels. And whenever I do fundamental analysis, all of that just comes copy pasted. You can literally just copy my charts, all of them. It takes 10 seconds, and all of my watch lists that I use for trading. That's it. That's everything I had for you guys today. Hopefully you enjoyed. Have a great rest of your weekend. I'll see you tomorrow for the top 5 options video. Take care and peace.